It is time to take a look at your money today, but first, here's a look at the weekly stock market recap. When they closed on Friday, the S&P 500 dropping more than 3%, the NASDAQ falling more than 4%, and the Dow Jones dropping by nearly 1,000 points. So after a brutal first 6 months of the year, investors enjoyed a 2-month summer rally as stock prices rebounded and appeared to be heading higher, but any hopes of the rebound would continue have quickly dashed over the past 3 weeks. The benchmark S&P 500 stock fallen by 8.3%. Not great news, Mark. Thank you so much for joining us, Mark Grywacheski from the Quad Cities Investment Group. So I guess, what is your reaction to everything that we've just kind of gone through right there?
I mean, like you said, we had this nice little summer rally, and all of a sudden it seemed to dissipate a little bit. Well, this graph here, David, shows the year-to-date performance of that benchmark S&P 500 stock index you just mentioned. And we need to remember, David, what caused this initial 6-month sell-off in the stock market to begin with. It was concerns over, high inflation, rising interest rates, the future outlook of the U.S. economy. Now, kind of from mid-June, up to mid-August here, we got this really nice rally in the stock market on the hopes that, maybe inflation had peaked, and therefore the Federal Reserve wouldn't need to be as aggressive in raising interest rates. Okay. But unfortunately, David, a few weeks ago, right about this time here, the Federal Reserve dashed much of those hopes when it stated that it doesn't see a sharp, quick decline in inflation. And that means that the Federal Reserve is going to have to keep interest rates higher for a longer period of time to help get this inflation under control. And the longer we have high inflation, the longer we have higher interest rates, the greater risk of a significant impact to the economy, which is reflected in this 3-week sell-off here.
Yikes. So looking at that, what do you think we're going to experience the rest of the year?
In my opinion, David, unfortunately, I think we're still going to see a fair amount of volatility throughout the rest of the year. Over the next, 6 months or so, as we get this steady supply of data, on the economy, on inflation, on interest rates, I think we're going to get this, this kind of ebb and flow of good news and bad news. And understandably, Wall Street is going to take its cues from that. Yes. And is going to react accordingly. So I still think we're going to see these large up and down price swings throughout the rest of the year.
Well, you talk about Wall Street reacting. What about us, the investor, who may be investing in our 401ks or our retirements? What should we be doing right now?
You and I have had some interesting conversations over the last few weeks on this. In my opinion, I still think this is a stock market, David, that's going to require patience until Wall Street gets some level of comfort that this very high inflation is under control. If at all possible, I'd recommend against selling out of the stock market, because if you're selling right now, David, look, you're selling near the low point of this current stock market decline. And it bears repeating again over the entire 130-plus year history of the U.S. stock market. The stock market has always recovered. It's always went on to set these new all-time highs. We just don't know how many days, weeks, or months that's going to be.
Always recovers, but it's not always as quick as we'd like.
Exactly. Yeah.
All right, Mark, thank you so much. And